You open your paycheck expecting to feel rewarded for your hours, but then you see the net amount. The taxes and deductions have already been scraped off the top before you even get to touch the money. If you try to fix this by simply working harder or putting in more overtime, you walk right into a mathematical trap. Because of how the standard employee tax structure works, increasing your gross income just increases the absolute amount the government takes. It feels inescapable today, but a permanent income tax is actually a relatively recent invention in American history. For a long time, the government operated without one. The irony is that the very tax system draining middle-class wallets right now wasn't forced on them by some tyrannical ruler. The masses actually demanded it, voted for it, and cheered when it was enacted. Originally, the government only levied taxes as temporary measures to fund specific conflicts, like the Civil War. Afterward, the tax was supposed to go away. That changed in 1913. This document is the joint resolution for the 16th Amendment, and when it was adopted, it made the income tax a permanent fixture of American life. To sell the public on a permanent tax, politicians leaned heavily on the Robin Hood theory of economics. They promised it was a weapon aimed exclusively at wealthy capitalists to redistribute their excess capital to everyone else. But the system had a fatal flaw. As cash flowed in, government spending expanded rapidly. The appetite for capital grew so large that the government couldn't sustain itself just by taxing the rich. They had to drop the tax brackets lower and lower, eventually swallowing the very people who voted for it. The attempt to punish the wealthy backfired. The middle class ended up building their own financial cage, while the rich, understanding how the rules actually worked, simply walked through a legal escape hatch. When most people hear the word corporation, they picture a massive glass skyscraper, hundreds of employees, or a sprawling factory. In reality, a corporation is just a manila folder in an attorney's office, a collection of registered documents creating a legal body without a soul. As soon as the permanent income tax was enacted, the wealthy retreated to this exact structure to shield their money from the government's reach. A corporation functions as a legal boundary that allows a person to separate their personal life from their financial activities, operating under a different set of rules entirely. Let's look at the math. A standard W-2 employee is forced into a rigid order of operations. You earn your income, the government immediately takes its share, and you try to survive on whatever is left over to spend. If you operate under the corporate rulebook, that sequence flips. A business owner earns their income, spends what they need to maintain their lifestyle, and then only pays taxes on whatever happens to be left at the end. The tax code allows businesses to deduct legitimate operational costs. If a trip to Hawaii is documented as a necessary board meeting, or a car is used for company business, those costs are deducted before taxes are even calculated. By the time the government gets a chance to tax that income, it has already been spent on these legally allowed expenses. This diagram shows exactly how that cash flow works. Notice the looping arrow flowing through the corporate income statement before it ever touches the personal side. By routing money this way, the corporate rulebook creates a massive wealth gap compared to a standard salary. There is a secondary benefit to this routing. By holding assets inside the corporation, the rich can maintain a relatively empty personal balance sheet. They control everything, but legally own nothing, making them incredibly difficult targets for lawsuits. This is the core asymmetry. Employees struggle because they buy their lives with post-tax crumbs, while the wealthy fund their lifestyles with pre-tax dollars. You can't just file some paperwork, open a corporation, and expect to get rich. Taking advantage of this asymmetry requires developing a very specific skill set known as our financial IQ. The first and most vital pillar is accounting. This is basic financial literacy, the ability to read the numbers and understand the strengths and weaknesses of any cash flow. The second pillar is investing, which is the science of using money to make more money. The third is understanding markets, reading the emotional and economic forces of supply and demand. The final pillar is the law. This is the technical knowledge of how to wrap your accounting and investing skills inside a corporate structure to access the specific tax protections the wealthy use to accelerate their growth. Relying entirely on a safe, secure job without developing these four pillars virtually guarantees you will spend the rest of your life working to serve the government. All of these structures are incredibly effective at protecting wealth once you have it, But that leaves a lingering question. How do the wealthy build that capital in the first place, especially if they start with absolutely nothing? The answer is that they don't wait around to find the same opportunities that everyone else is looking for. They use their financial intelligence to invent those opportunities completely out of thin air. Did you know corporations could be used this way? Or did you think they were just for massive companies? Let me know in the comments below. Hit that subscribe button and drop a like if this changed how you look at your paycheck. I'll see you in the next one.